As we said, Powell on the Hill yet again tomorrow, and we'll obviously be covering that. Joe, you see what the market's doing. You heard what the Fed chair had to say. No great surprises.
No
obviously,
great
the market's not reacting as if there was.
Shouldn't be. I thought he was more focused, by the way, on the labor market, which is interesting because that really signals to the doves that if you're expecting this rate cut in September, you're certainly going to get it based on the trend that we're currently seeing right now. Listen, 25 basis points in September doesn't do much, in my opinion, to where we are in the economy or where we are in the stock market. It's more a gesture that what we've witnessed from an adversarial Federal Reserve is no longer in place.
If it's just 25.
Yeah, if it might even be. No, and I got to tell you, that's a good point, because if we see further deterioration in the economy, you're going to start talking about 50. But collectively, all of that, I just don't see how it brings forth enough evidence to suggest you want to make a pivot away from what's really working in the market right now. And that's the exposure to semiconductors and AI-related technology. I just can't get to a place where I'm going to say, okay, small cap industrials, small cap materials, small cap financials are going to be the place to be over the next 6 months.
Yeah, Jenny, semi-index, the stocks today hitting a new high for the first time since June 18th. You do have the market, which has been largely reacting. Good news has been good news. Bad news, so to speak, on the economy has been taken as reasonably good news, or we wouldn't be putting in these new highs in the S&P and the NASDAQ just about every day. However, Goldman Sachs today suggests that bad news might become bad news at some point from the markets. But then you also have the idea that if it does, and I think that's why the Fed chair talks about risks on two sides, that they're going to cut.
Right. I think that's so interesting because it is this challenge of balancing two risks. We have to see the consumer weakening. We have to see the economy weakening before he can cut to support. I'll tell you what I'm really looking at, though. What I'm looking at, and I think it's interesting, Joe, where you say, like, for right now, nothing should change what's working, right? But what's going to be interesting is when those cuts come, what happens to rates? We're pretty sure, and they should, that short-term rates should come down. Money market funds should come down. The short-term end of the curve should come down. But what I think is interesting, where the conversation could change, and other things start to work, is what happens to the long end. And right now, we even saw over the last quarter the long end of the curve, the 10-year Treasury, tick up. But let's say we get that cut in September, and let's say the long end starts to come down. Then really what hasn't been working, then it could start to work, because then cuts become meaningful for companies' balance sheets, right? They become meaningful for a lot of the stocks that I'm in, where you could almost look at them as bond proxies and say, oh, well, with a 10-year at 4.3%, why would you buy a dividend stock? Why would you buy a value stock with this multiple? But once their balance sheets start to become improved by rates coming down, once there's less competitive threat from the fixed income market out there, then what hasn't been working could work. So I think, Scott, we're in kind of a let's wait and see. Everything's so far just exactly what it should be and what Powell's expecting. Nothing new.
Bryn, as I come to you, rather than parsing Powell, because I want to get away from that, I want to talk strategy. If you think that we're going to get rate cuts starting in September, and this is the chair laying that groundwork, as we said, what do you do in the market?
So I think to build on what Jenny was talking about, rates and the rate cut, we have an equal weight, right? Like we have the RSP as an equal weight that we put on the beginning of the year, thinking that we would have more breadth. We have not had more breadth from an RSP and equal weight perspective. I think, though, if you actually started to get the long end decline, the long end is decided by the market. The only reason the long end would decline is if the economy was weakening. And so to me, that's somewhat of a threading of the needle of if you want to go into small caps or more sectors that are levered to the economy, you really want the long end, when a rate cut happens, to start steepening because it's showing the economy is actually somewhat resilient. And so I think that as we're going through the year, from a positioning perspective, if GDP continues to come down, if the labor market and unemployment continues to tick higher, I think that's going to be a difficult set of ingredients for the others to work meaningfully. That being said, as we're entering this earnings seasons, outside of tech, and then I would say communication services, tech adjacent, the two biggest sectors that are going to grow quite a bit faster than the S&P are what? healthcare, and energy. And so I think this is a time to pick your spots. You want to be in sectors and securities that are actually growing faster than the S&P from an earnings or a revenue perspective. I think that's how you're going to get performance that's not so biased of what does the economy do, what does the labor market do. And so that's why I think investors should position towards that manner.